Throughout nearly a century, Warren Buffett has made countless accurate predictions about the devastating upheavals of the global economy. But perhaps his final warning in this letter to the world is the clearest sign of an impending financial tsunami that could wipe out everything. Many people believe Buffett holds an enormous amount of cash out of fear that the dollar will lose its value. But the truth is, he has never truly believed in paper money. What he believes in is the law of greed and fear. In investing, when the whole world is chasing after surface-level profits, the wise few silently wait to seize everything at the depths of market despair. Look back at history. In 2005, when no one thought the financial markets could collapse, Buffett quietly began accumulating cash. The green line on his cash ratio chart surged upwards, signaling a looming asset purge. 3 years later, the 2008 financial crisis hit, wiping out millions of greedy investors. Meanwhile, Buffett, who had been patiently waiting for 3 years, started pouring his cash into assets priced cheaper than worthless paper. When the world saw him emerge wealthier after the crisis, they thought it was luck. But the truth is, Buffett never waits until the market crashes to act. He always prepares years in advance, while everyone else is still intoxicated by profits. A similar scenario unfolded in 2020. Just a few years before the COVID-19 pandemic crashed the markets, Buffett quietly began selling off assets, raising his cash reserves to the highest levels in years. Then, as the US stock market hit rock bottom, he deployed his massive cash pile to buy up stocks at bargain prices, doubling his fortune within just a few short years. Now, the cash ratio chart is once again rising rapidly, reaching levels equal to those in 2005, the same signal that warned of the 2008 crisis. But this time, Buffett's final warning could signal a financial storm far more catastrophic than anything we've ever seen. Buffett says he's leaving this massive cash reserve to his successor. But perhaps that's just a metaphor. What he's truly leaving behind is a once-in-a-lifetime opportunity for those patient enough to wait. If you truly understand this pattern, you'll realize that the best time to invest isn't when the market is booming, but when fear consumes everything. Opportunities like this may only come once in an entire lifetime. Buffett has waited nearly 20 years for this moment. But what about you? This letter may be the final reminder Buffett gives to all of us. His previous letters are now nothing more than history, but this final letter could be the key to unlocking unimaginable wealth in the next decade. The game has already begun. The crash could happen at any moment. The question is, will you be the prey or the predator? If you want to know how to seize this opportunity and avoid becoming a victim of the upcoming financial storm, subscribe to my channel today. I'll continue sharing the most valuable insights to help you turn crisis into a once-in-a-lifetime opportunity. And don't forget to like this video to save the content, because what I'm about to share could be the secret to breaking free from your current financial status and stepping into a brand new journey. Time waits for no one, and opportunity only belongs to those with vision. Do you have the patience and courage to move against the crowd like Buffett? Make your decision now. Why did Warren Buffett recently warn that the US dollar could become worthless, yet continues to liquidate assets for cash? This is not a contradiction, but rather a sophisticated financial strategy that discerning investors can appreciate. In reality, Buffett doesn't hold cash merely as US dollars. A significant portion of his liquid assets is invested in short-term US Treasury bills, which have maturities ranging from 3 months to a year and can be readily converted to cash. These short-term treasuries are akin to cash equivalents, offering interest earnings with minimal market volatility over short periods. Think of cash as water and short-term treasuries as ice. Both are essentially the same, but in different states. When needed, ice can melt into water, mirroring how Buffett manages his assets. Amid rising interest rates, Buffett strategically sold equities and redirected the proceeds into short-term treasuries, yielding up to 5%. This move not only preserves capital, but also generates higher returns in the short term. Importantly, Buffett avoids long-term bonds with maturities of 10 or 20 years, which have depreciated significantly due to increasing rates. He opts to lend to the US government over shorter durations. ensuring his investments remain liquid and responsive to market shifts. However, the crux lies in Buffett's cautionary statement. When he mentions that the US dollar could become worthless, it's not an absolute prediction, but a warning to the US government. Continued fiscal mismanagement, excessive money printing, and mounting debt could erode the dollar's value. Consider this analogy. Consuming too many sweets may lead to cavities. This doesn't guarantee dental issues, but serves as a caution to moderate sugar intake. Similarly, Buffett isn't asserting the dollar's inevitable decline. He's urging the US government to adjust its policies to prevent such an outcome. So, what measures can the US government adopt to avert this potential crisis? 3 plausible strategies include: 1. Increasing revenue through taxation or alternative funding sources. However, this approach isn't immediate and may not suffice to address the debt crisis. 2. Reducing expenditures by lowering interest rates. Yet this tactic is double-edged. While it might alleviate government debt, it could also deter investors from purchasing U.S. treasuries, leading to financial gridlock. 3. Expanding the money supply and balance sheet. This is the swiftest method, but risks significant dollar depreciation. For instance, borrowing $100 and repaying only $50 due to currency devaluation might seem advantageous, but overuse could render the dollar virtually worthless. Buffett recognizes that to attract buyers for U.S. treasuries, especially during economic downturns, investors might shift from the stock market to safer assets like government bonds. This shift could be prompted by a declining stock market, making bonds more appealing. When the U.S. economy thrives, investors flock to equities for higher returns. Conversely, during economic slowdowns, increased risks make stocks less attractive, leading investors to seek refuge in short-term treasuries with favorable yields. This dynamic may explain Buffett's recent warnings. He's not only safeguarding his assets, but also subtly influencing a capital migration from equities to government bonds. What's Buffett's next move? He might patiently await a market bottom before deploying his substantial cash reserves to acquire undervalued assets. This strategy aligns with Buffett's enduring investment philosophy: be greedy when others are fearful, and fearful when others are greedy. Declaring that a country has fallen into recession is an extremely sensitive issue, especially for leading economies like the United States. When a government officially acknowledges economic decline, it can cause panic in financial markets, shake investor confidence, and trigger a chain reaction of negative consequences. However, no matter how much the authorities try to control the narrative, objective economic data still points to the harsh reality that the U.S. economy is facing unprecedented challenges. Lately, I feel like I'm living in a past era when investors glued their eyes to TV screens, tracking every tiny fluctuation in the financial markets. Remember a few years ago when Donald Trump could send the stock market into a frenzy with just a single tweet? Back then, he constantly urged the Federal Reserve, Fed, to inject money into the economy, boosting stock prices significantly. But what about this time? Trump has remained completely silent in the face of the current situation. Just as I was about to turn off the TV, the U.S. Treasury Secretary appeared, stating that the government's top priority right now is to control long-term bond interest rates to ensure they can still be sold on the market. This means the government is trying to maintain confidence in U.S. Treasury bonds, an essential tool for raising capital. But is that really feasible? Looking at the Fed's financial situation, it's evident that since 2022, its reserves have been steadily depleting. With resources running low, the Fed has been forced to borrow money from banks and financial institutions through a mechanism called reverse repo, reverse repurchase agreement. Simply put, the Fed is using U.S. government bonds as collateral to borrow money from its own financial system. However, recent data shows that the Fed's borrowing capacity is gradually shrinking. If the chart continues its downward trend to zero, it would mean that even the financial system itself is no longer willing to provide liquidity to the Fed. There are 2 main reasons for this. First, financial institutions may have run out of money and no longer have the ability to lend to the Fed. Second, even if they do have money, they may prefer to hold on to cash rather than accept U.S. Treasury bonds as collateral, fearing their future value. And when there are no buyers, what happens? U.S. Treasury bonds will lose value, leading to a liquidity crisis in the market. What's even more concerning is that China, Japan, the UK, and several other countries have been dumping U.S. Treasury bonds in recent years, worsening the situation. As the number of sellers continues to rise while buyers become increasingly scarce, the U.S. bond market risks freezing. This is a serious issue because if the U.S. government cannot raise funds through bonds, it will struggle to pay off debts and finance its economic operations. To counter this crisis, the U.S. government may implement a series of drastic measures. They might cut public sector jobs and pressure large corporations to lay off employees to increase the unemployment rate. While this could help curb inflation, it would also trigger a labor market crisis. Additionally, they might raise tariffs to stimulate domestic production while deliberately increasing inflation to reduce the national debt burden. Another possible strategy is that the U.S. government could impose more economic sanctions on other countries, or even deliberately provoke a financial crisis to restructure the economy. This model isn't new. Before rebuilding, they must first tear down the old structures. This is how some leaders believe they can make America great again. However, the cost of this approach could be extremely high, not just for the United States, but for the entire global economy. This is not the time to waste a good crisis. While most countries around the world are stuck in a downward economic spiral, smart money will flow into safe havens, assets that have been carefully prepared in advance. This is an opportunity not only to protect wealth, but also to create a new generation of wealthy individuals. If you don't want to become a victim of this crisis and instead aim to rise to a higher economic class, closely follow market developments. I will continue to provide you with the most important information. If you're worried that you might forget what you just read, save this article. Doing so will allow you to refer back to it anytime and take advantage of potential opportunities in this period of chaos. Why is U.S. Treasury liquidity drying up? Many people might wonder, why doesn't the U.S. simply use its own money to pay off its debts? On the surface, this seems logical. If a country can print money, why can't it just pay off all its debts? However, the reality is far more complex. The U.S. dollar cannot be easily recalled, and that is the key to the issue. Let's take a closer look at how the U.S. financial system operates. U.S. Treasury bonds function as part of a cyclical process of borrowing, spending, collecting, and repaying. When the Federal Reserve prints $5 trillion, it uses this money to buy Treasury bonds, essentially lending money to the U.S. government. This means that the government now owes the Fed $5 trillion. But this money doesn't just sit idle. It is immediately spent on importing goods from all over the world, including oil, raw materials, technology products, and consumer goods. Over time, this $5 trillion gets fully spent, leaving the U.S. government in a liquidity shortage. So what happens next? This is when the U.S. financial system implements a strategic plan to ensure the continued flow of U.S. dollars. The key issue is the ability to reclaim the money that has been injected into the global economy. If the U.S. can recover $4 trillion out of the $5 trillion it has spent, then only $1 trillion remains in circulation worldwide. This shortage of dollars on the international market forces other countries to keep selling goods to the U.S. in order to obtain more dollars. This creates a cycle where the U.S. can keep printing money to buy goods without facing the risk of hyperinflation or currency devaluation. There is an undeniable truth. The U.S. government is carrying an enormous debt burden, currently standing at $36 trillion, and this number continues to grow. Some even predict that in the future, it could reach $100 trillion, or even $1 quadrillion. However, despite this massive debt, the U.S. financial system still operates smoothly. Why is that? The answer lies in a clever strategy that the U.S. state has applied for decades, delaying debt repayment by extending time, or in other words, using time to gain space. This means that the U.S. does not necessarily have to repay its existing debt immediately, but can continuously restructure it by borrowing new debt to pay off the old one. Let's take a simple example. If today the U.S. owes Japan $1 trillion and this debt is due, the U.S. can ask Japan if they are willing to continue lending. In return, the U.S. will continue paying interest. If Japan agrees, the debt remains without requiring an immediate payment. But if Japan refuses, the US can seek another lender, such as the UK, to borrow $1 trillion and repay Japan. 30 years later, the US will find another way to manage this debt. This strategy allows the US to maintain its financial operations without facing immediate repayment pressure. Theoretically, as long as the US can continuously recover the money it has issued, keeping the global economy in a state of dollar scarcity and ensuring countries still need US dollars for transactions, it can continue printing money without major issues. This system has worked smoothly for many years, but recent developments indicate growing instability. In the past, around 40 to 50% of U.S. debt was funded by foreign countries purchasing U.S. Treasury bonds. However, today, that percentage has dropped to just 20-30%. This means that the money the U.S. has injected into global markets is no longer returning as before. So, what are the consequences? If U.S. dollars issued into the world are not being recovered, global markets will no longer experience a dollar shortage. In this scenario, if the U.S. continues expanding its balance sheet and printing more money, the dollar will depreciate significantly. This would make other countries even less inclined to hold U.S. dollars or buy U.S. Treasury bonds, further worsening the cycle. What solutions is the U.S. seeking? In response, many believe that the U.S. government, especially under Donald Trump, has been actively seeking ways to attract capital back into the country. Some measures include increasing import tariffs, encouraging businesses to invest more in the U.S., even selling U.S. citizenship for $5 million per applicant seeking to immigrate. These efforts aim to maintain the financial system that the U.S. has long relied on. However, one crucial point that many fail to recognize is that America's massive debt doesn't actually need to be repaid immediately. And in reality, it cannot be fully repaid. If the U.S. were to pay off all its debt, the global financial system would collapse instantly. Why? If the U.S. successfully retrieves money from around the world and uses it to pay off its debt, it would drain liquidity from the market, causing a severe financial contraction worldwide. The biggest creditor of the U.S. is not another country, but the Federal Reserve, Fed. In the past, the Fed printed money and lent it to the U.S. government. If the government now repays this debt, it would essentially be destroying that money, removing it from circulation and shrinking the economy. Why doesn't the U.S. focus on production instead of printing money? If hard work alone could make a nation wealthy, then why doesn't the United States focus on manufacturing and production instead of constantly printing money? The answer is simple. Labor is too exhausting, while printing money is much easier. The U.S. government can issue bonds, attract capital from around the world, and then continue printing money without having to generate real value. However, there is one truth that few people realize. The U.S. has no intention of fully repaying its debt. If they were to do so, their own economy would collapse. Imagine if the U.S. collected $100 million and used it to pay off debt. Theoretically, this sounds good, but in reality, this debt doesn't need to be paid off immediately. If they still decide to do so, they would be removing that money from the financial system, leading to a shortage of cash flow, liquidity drying up, and an economic slowdown. What would happen next? Wall Street could crash, businesses would run out of capital, people would lose their jobs, and the U.S. economy would fall into a deep recession. In the worst-case scenario, real estate prices could plummet. Luxury apartments in downtown New York might drop to just $100 per unit. But don't celebrate just yet, because by then, the value of most people's assets will also have collapsed to nearly zero. Banks would have no money to lend, so even if housing prices seemed unbelievably cheap, no one would have enough money to buy them. Many people assume that if the U.S. repays all its debt, the economy will become more stable. But in reality, paying off debt means withdrawing money from the economy, causing a decline in cash flow and leading to a severe recession. For this reason, no U.S. president has ever seriously pursued national debt repayment. The promises of reducing debt are merely political slogans meant to reassure the public. The true mission of the U.S. government is to retain control over the issuance of money, pull capital from the global market, and continue expanding national debt. The more debt they accumulate, the more money they can print, and the weaker the dollar becomes. However, when money is injected into the market, it needs assets to absorb it. If not, uncontrolled inflation will occur, causing asset prices to skyrocket. In the past, the US could easily reclaim capital by selling government bonds to other countries. But today, many nations are gradually reducing their purchases of US bonds, making it harder for America to bring money back into its financial system. So what is their solution? The answer is simple: raising interest rates. Imagine you lent the US $1 million at an interest rate of 1%, meaning you would earn $10,000 per year in interest. But if you no longer want to lend money, the US will increase the interest rate to 5% or even 10%, meaning you could now earn $50,000 in interest. This strategy attracts global investors back into the US bond market, successfully drawing money back into the system. However, there is a major issue. Most investors now prefer to buy short-term US bonds rather than long-term ones because they don't trust the stability of the US dollar in the long run. As the US stock market surges, many speculators jump in, pushing stock prices even higher. This creates a dangerous financial cycle. The US must pay higher interest rates to borrow money, but that in turn increases their debt burden, forcing them to print more money to sustain the system. In reality, the more money they print, the more debt they accumulate, and the weaker the US dollar becomes. But ironically, this helps America maintain its financial dominance. When more money enters the market, it must be absorbed by assets. Otherwise, runaway inflation will occur, making prices of goods and real estate soar uncontrollably. How can small investors take advantage? In such a volatile market, small investors actually have a major advantage over financial giants like Warren Buffett: flexibility. Large investment funds like Buffett's must plan their moves years in advance when buying or selling assets. Meanwhile, small investors can wait for the right moment when money starts flowing into the market and pushing stock prices up before making their move, and it's never too late. In other words, big players create trends, while small investors simply follow the trend and cash out at the right time. The US government has long relied on government bonds to raise funds from around the world. By issuing bonds with maturities of up to 30 years, they can borrow money without having to repay it immediately. The funds raised from these long-term bonds are then used to pay off short-term debts that are coming due, creating a massive financial cycle that, in theory, can be sustained indefinitely. However, this system is now facing a major problem. In the past, global investors flocked to buy US bonds because they were considered one of the safest assets in the world. But now, that trust is being shaken. Currently, short-term bonds still have buyers, but long-term bonds are being largely ignored. The reason is obvious. No one wants to lock their money into a 30-year investment when the US economy is facing so much uncertainty. The US financial model, based on borrowing long-term to pay off short-term debt, is on the verge of collapsing. If this happens, the US government will face an extremely difficult challenge: how to pay off short-term debt in an environment of rising interest rates and a lack of buyers for long-term bonds. For example, in 2025 alone, the US has approximately $8 trillion in debt coming due. At the same time, they need to borrow an additional $2 trillion to keep the government running. The problem is that the National Treasury currently holds only about $600 billion, a figure far too small compared to actual needs. With insufficient funds to pay off debt, the US may be forced to print more money. But this is a dangerous double-edged sword. If the US government prints more money without retrieving enough dollars first, the value of the dollar will plummet uncontrollably, pushing the economy into a severe currency crisis. At that point, the US dollar could lose significant value and become little more than worthless paper. So what will the government do to salvage the situation? The answer lies in a sophisticated economic manipulation strategy. The US Treasury Secretary recently stated that the most important goal right now is to sell long-term bonds. But how can they convince investors to return to long-term bonds when trust has already been lost? The simplest way: create a financial crisis to force them into it. Recently, a branch of the US Federal Reserve, Fed, forecasted that US GDP would contract. This was not a coincidence, but part of a plan to manipulate financial markets. By continuously releasing negative data about the US economy, they have created a wave of panic among investors. When investors believe the U.S. economy is heading into a recession, they fear losing money if they continue to hold stocks, real estate, or other risky assets. In this context, U.S. government bonds suddenly become an attractive choice. They don't just want you to buy regular U.S. bonds, they want you to buy long-term bonds, which are currently offering interest rates of 4 to 5%, an incredibly attractive figure during a financial crisis. If investors buy now, they can lock in these high interest rates for the next 30 years. But if they hesitate, once everyone rushes in to buy, interest rates will drop and bond prices will rise, making them more expensive to acquire in the future. This creates a race to secure long-term bonds, allowing the U.S. to raise massive capital to keep its financial cycle running. The U.S. is playing a dangerous financial game. On one hand, they create a crisis to drive money into long-term bonds. On the other hand, they continuously print money to sustain their massive national debt system. In the context of the U.S. economy facing major challenges, global investors are closely monitoring every fluctuation in the financial markets to determine their next move. U.S. government bonds, once considered the safest asset in the world, are now entering a period of volatility as supply surges while demand remains weak. From here, three possible scenarios could unfold, each with far-reaching impacts on both the U.S. and global economies. Scenario 1, U.S. bonds succeed and the stock market stabilizes. Scenario 2, U.S. bonds surge, causing a stock market collapse. Scenario 3, the stock market crashes and even U.S. bonds fail to provide support. Among these, Scenario 2 is the most likely. In this case, U.S. bonds will become an attractive destination for capital due to rising interest rates, leading to a sharp downturn in the stock market. History has seen similar scenarios during the 2008 financial crisis and the COVID-19 pandemic in 2020. When investors panic, they pull money out of stocks and pour it into safe haven assets like bonds. In this situation, the U.S. will recover a large amount of money from bonds, allowing the Federal Reserve, Fed, to expand its balance sheet and print more money without facing significant obstacles. This newly printed money will be funneled to major financial institutions at near zero interest rates, enabling them to buy back stocks at lower prices. As a result, the U.S. stock market could rebound within a short period, just as it did after the 2008 and 2020 crises. This is why Warren Buffett and major investment funds are currently holding massive amounts of cash. Regardless of whether Scenario 1 or 2 plays out, the U.S. stock market will decline first, and those with available cash will seize the opportunity to buy at low prices. Lesson for investors: opportunities in crisis. If you understand how the market operates, you won't just avoid risks. You could make money faster than at any other time in history. In 2008, many people were just workers or waiters, but after the crisis, they became millionaires. The wealth gap widens after every crisis, and those who seize the opportunity will be on the winning side. I was born after 2008, so I couldn't take advantage of that opportunity, but this time I am ready. My strategy is clear. Monitor the U.S. bond market to assess trends. Engage in short-term, tactical trading. Take profits quickly. If U.S. bonds are rescued, prices will rise even further. If conditions worsen, I will adjust my strategy immediately. In the coming period, I will continue updating on important market developments. If you don't want to miss out on opportunities, stay closely tuned to the market and always have an investment plan in place. Because in a crisis, opportunities are only for those who are prepared.